The Fair Share Levy is our proposed levy on the sale of Australia's gas resources. It's based on the system that works so well in Norway. It would raise billions each year for the Australian public to help fund essential services like health, education, and housing, all without raising costs for businesses. The Fair Share Levy is economically neutral. That means it doesn't impact future investment or jobs. It doesn't raise gas prices or change the amount of gas sold. It doesn't even change the incentive for firms to invest here. It simply means that more of the wealth created from gas resources is shared with the Australians who actually own them, rather than most of it being sent overseas. Sounds too good to be true? Let me explain how. So under the Fair Share Levy, the government takes a consistent share of a project's cash flow, whether that cash flow is positive or negative. That leaves the rate of return to investment unchanged. To see how this works, here are the returns to an illustrative gas project before any tax kicks in. You can see that during the initial investment phase, large upfront capital expenditures mean that the project is making losses. Over time, it starts to generate revenue in the return phase. The relationship between these two phases produces an overall rate of return on investment. And if this exceeds the firm's hurdle rate of return, then the project goes ahead. Now, under standard taxes, like the corporate tax, the government takes a slice of revenues in the return phase. And this tax, like other conventional taxes, reduces the rate of return on investment. This can bring it below the firm's hurdle rate of return, which kills the project and its associated jobs. And this is why, although taxes are essential to a working economy, economists and the public worry about their effects on economic growth. But the Fair Share Levy works differently. Here, the government takes an equal share of both revenues and costs. In our design, that share is 40%. So the firm pays only 60% of the cost of getting the project going and then reaps 60% of the returns. Because the ratio between costs and revenues is exactly the same before and after the tax, the overall rate of return also remains identical. Think of it as the government behaving like a silent partner. As we all know, changing the shareholders of a firm, whether the share is held by Sheila or Barry, does not change whether projects have a positive return, how much they'll produce, or at what price. All that changes is who shares in the benefits when the project succeeds. The managers of gas firms will, of course, claim otherwise. They'll tell you that it will increase prices, reduce gas availability, or reduce their likelihood of investing. Managers will say this because it's their job to say it. They're paid by mainly international shareholders to look after the interests of those shareholders. But we know from around 80 years of economic analysis of cash flow taxation and from experience in countries such as Norway that this tax works just as intended.